a lion city roaring Singapore's economic miracle. Singapore, often referred to as the Lion City, has undergone a transformation that is nothing short of miraculous. This tiny island nation is an economic powerhouse. Despite its small size, Singapore has managed to carve out a significant place for itself on the global stage. It boasts a high standard of living. The quality of life here is among the highest in the world, with excellent healthcare, education, and infrastructure. Its GDP per capita rivals that of major developed nations. This is a testament to the country's robust economic policies and strategic planning. Singapore has achieved remarkable economic transformation in just a few decades. From a developing nation to a first-world country, its journey is inspiring. From its humble beginnings as a trading post, Singapore has evolved into a bustling metropolis. The city-state's strategic location has always been a key factor in its success. Singapore has become a global financial hub. It is home to some of the world's largest banks and financial institutions, making it a critical player in the global economy. It is a testament to sound economic policies and strategic planning. The government has played a crucial role in fostering an environment conducive to business and innovation. Singapore's success story is the envy of many nations. Countries around the world look to Singapore as a model for economic development and governance. However, a closer look at its debt-to-GDP ratio raises eyebrows. While the nation has achieved much, it faces challenges that require careful management to sustain its growth. A debt giant, unpacking Singapore's 160% ratio. Singapore's debt-to-GDP ratio stands at a staggering 160%. This figure seems alarming at first glance. Many countries with such high ratios face severe economic crises. Greece and Japan come to mind. These nations grapple with unsustainable debt burdens. However, Singapore defies this conventional narrative. The country's economic fundamentals remain strong. There's more to the story than meets the eye. The unique DNA of Singapore's debt safe and sound? Singapore's debt is different from other countries. It's largely non-inflationary. This means it doesn't lead to price hikes. The debt is also asset-backed. This signifies that it's supported by tangible assets. These assets include reserves and investments. This backing provides a safety net. It ensures that the debt is manageable. This unique structure sets Singapore apart. The CPF connection Singapore investing in itself. A significant portion of Singapore's debt is held domestically. This means that the country relies heavily on its own financial resources and citizens to fund its development and growth. By doing so, Singapore ensures a stable and sustainable economic environment. The Central Provident Fund, or CPF, is a key holder. Established in 1955, the CPF is a comprehensive social security savings plan that has been instrumental in shaping the financial landscape of Singapore. This is Singapore's mandatory savings scheme. Every working Singaporean and their employer contribute a portion of their monthly wages to the CPF, ensuring that citizens have a safety net for their future. It covers retirement, healthcare, and housing needs. This multifaceted approach ensures that citizens are well prepared for various stages of life, from buying their first home to securing their health and retirement. The CPF invests a portion of its funds in government bonds. These investments are crucial as they provide a steady return, ensuring the growth and sustainability of the fund. These bonds contribute to the national debt. However, unlike external debt, this internal borrowing is a strategic move to keep the financial ecosystem robust and resilient. This arrangement ensures that the debt is primarily owed to its citizens. By doing so, the government maintains a high level of trust and accountability with its people. It's a form of internal borrowing. This strategy not only strengthens the nation's financial independence, but also fosters a sense of collective responsibility and shared prosperity among its citizens. Section 5. Fiscal Prudence, the Lion City's secret weapon. Singapore is known for its fiscal prudence. The government consistently maintains a balanced budget. It avoids excessive spending. This discipline ensures that the debt remains under control. International credit rating agencies recognize this. They consistently award Singapore with top-notch credit ratings. These ratings reflect the country's strong financial standing. Section 6. Weathering the storm, the Singapore dollar advantage. Singapore's debt is primarily denominated in Singapore dollars. This minimizes exchange rate risks. Fluctuations in foreign currencies have a limited impact. This is in contrast to countries with significant foreign currency debt. They are vulnerable to currency depreciation. This can make debt repayment more expensive. Singapore's reliance on its own currency acts as a buffer. Section 7. Navigating headwinds, future challenges and risks. Despite its strengths, Singapore faces challenges. Global economic downturns can impact its finances. A slowdown in global trade would affect Singapore. The country is heavily reliant on trade. Rising global interest rates pose another risk. This could increase the cost of servicing its debt. Singapore must navigate these challenges carefully. Section 8, A Sustainable Path. Singapore's Debt and the Future. Singapore, a global financial hub, has always been known for its robust economic policies and strategic planning. Singapore's debt-to-GDP ratio, while high, is manageable. This ratio is a critical indicator of the country's financial health, reflecting its ability to pay back debts without compromising economic growth. The country's unique debt structure, fiscal prudence, and strong economic fundamentals provide resilience. However, vigilance is key. The government employs a mix of domestic and international borrowing, ensuring a balanced approach to debt management. The government must continue to manage its finances responsibly. This includes maintaining a budget surplus, investing in infrastructure, and ensuring social spending is sustainable. It must adapt to changing global economic conditions. The global economy is ever evolving, and Singapore must stay ahead by being flexible and innovative in its financial strategies. By doing so, Singapore can ensure the sustainability of its debt. Long-term planning and strategic investments are crucial to maintaining economic stability and growth. This will secure its economic future for generations to come. A sustainable debt path means a prosperous future, where the benefits of today's prudent financial management are enjoyed by future generations.